Now we're going to talk a bit about how things have changed with OPEC. You know, what are the expectations from from OPEC itself, the IEA, EIA, when you're looking at some of the builds or surpluses that were expected. So when you look at where they were, so they were producing, depending on who you ask, anywhere between 28.5 to 29 million barrels a day. And this technically should take down about a million, depending on who you ask. But when you look at the expectations, you can see that the reduction is a bit lower. So it's going to be important to look at how is supply adjusting. Is that adjusting in any meaningful way? But even with that, you know, and obviously, as you can see, demand has been fairly stable, because when you look at the expected surplus, it's down. Now, if you look at OPEC, the balance is supposed to be negative 600,000 barrels, IEA negative 700,000 barrels, US EIA plus 400,000 barrels. So you're talking about a industry that consumes, let's just average it out, at 100 million barrels a day. And people are trying to predict if 2023 is going to be a net balance of 600,000 or 200,000. Again, you're the level of unknown within that can swing things. Because say, for an example, you know, there's something and there's a reduction of 1 million barrels a day. That easily takes away that balance. So that's why I think that what they did was take away any question of a big surplus and just essentially puts us into a bit of a tighter market. Whether it be increase or decrease, again, it's an unknown at this point, and it's just going to be something that we're going to have to pay attention to and watch out for. Now, when you look at crude oil production going into it, according to secondary sources in the OPEC file, March was at 28.7, 28.8 million barrels a day. You know, when you look at what was the driver, Saudi had an increase of 44. You know, Angola was the biggest driver with a drop of 64,000. Nigeria, again, 17,000, and then obviously Iraq down 18,000. But it's a matter of the production levels versus the export levels. And that's going to be the key piece, because I think there's still a lot of uncertainty as to what will actual production be, but also what will exports be. Are we going to see a bigger shift? Are we going to see these cargoes come off the water? And if so, by how much? And that's why there's still a lot of unknown as to how strict they will be, and really, will they come to pass? World oil demand, you know, they took 2022 down slightly, not by much, but again, just to give you an idea of where we are. But it's more important as to 2023. So when we look at the revisions in second quarter, they took it down 60,000 barrels. In third quarter, down 110. In fourth quarter, down 120. But as we've been saying, it's difficult to say 120,000 up or down. But when you look at the demand levels, you know, total world demand, they have at 103.4 for the most part in the fourth quarter. And if you look at anything that's happening, if you look at the global economy, we just struggle with those levels. And whether that is a reduction driven because of inflation, because inflation is still sticky around the world, we'll talk more about that in the Econ show. That's where we struggle with some of these big increases. You know, do we think it's going to stay around 100 million barrels a day? Absolutely. But it's the increase of that 100 to that 3-4 million barrel a day increase that is where we struggle, which is why the cut is announced the way it was. But one of the things is they announced the cut for May through December. You know, so the question is, well, shouldn't they have just done it for the summer and then reassess? And they've said they're going to reassess every month. And so, but the uncertainty is, as prices stay up here and demand continues to diminish, and let's be fair, we're going from, let's just using Brent from 75 back to 85, you know, that's a $10 spread. That doesn't help the inflation situation. That doesn't help the demand situation. And so that's going to, again, I think, eat into demand a bit more, which is going to create again, pull these numbers down and essentially just keep us on the positive side of this, create more of a surplus. But I'm not saying that we're going to get a 2 million barrel a day surplus. It's just we're splitting hairs between a build of 400,000 or a decline of 600,000. So do we have builds of 1 million? Maybe. Do we have builds of 400,000? Sure. Like I just think that we're going to be on the positive side of that equation and see net surplus by the end of the year. So then, with that being said, OPEC could cut again, and because we've seen they want to keep it at 85, and we still have our range between 82 and 87, but we just see more risk to the downside given what we've seen with retail sales and the other data points, and the risk to the downside would put Brent, let's call it between 80 and 85, which is where we think kind of that next level is. It would fill the gap which we have, which we all know, technical analysis, everyone loves to fill a gap. So that'll be a key one to watch as well. Cost of shipping Russian oil drops, so that just makes it easier. And we're going to see some of those flows, again, remain robust into the Asian theater. And it's just when you look at it, that's where they have to go. So one of the things, when you look at Russia and you look at the fact that they're part of the quote unquote voluntary cut, the Russian cut isn't voluntary. They have to cut. Because they're overwhelmed based on they don't have the same level of storage as everyone else because they've relied so much on pipelines. There's reductions of oil going into Europe, refined products going to Europe. So the refiners can't operate to the same levels, which then kicks oil out of the refiner and into the stream that has to be exported. So they have to. But as you can see, it's all going, or at least a large part is going into China and India. And then the others going into unknown Asia and other unknown, which is Asia. Again, it's all going to Asia. That's the net buyer, and that's going to continue, and that should actually accelerate a bit, especially as prices have come down. Now, China's crude throughput rose to a record in March, but that's one of the caveats that we've been seeing is that you had that nice run up, but now you're actually seeing some seasonal maintenance in April and May, which may mean that refiners reduce their processing rates. So you had that nice run, nice pop, and then you get a bit of a fade. Not to say that we're going to go to 12 million barrels a day, but more along the lines of 14.5 as you get some of that cooling off. And they do have a lot of product that they have to try to manage, whether that's into exports or into trying to preserve it into the underlying market. Because a total of 62.4 million tons of capacity was under maintenance as of April 13th, compared with 39.3 million tons 2 weeks earlier. So essentially maintenance doubled in the first week of April, which again is going to adjust this a bit lower. And we have a chart on that in a few minutes. Middle East crude continues to build. When you look at floating storage, which is again a bigger concern and one of the key drivers of why they're doing this, but the OSPs don't make it any easier, which is why we still see crude getting stranded in the Middle East floating storage. Because why would anybody buy above their term contracts given where pricing is? Nigeria has a bit of a force majeure, which is a bit of a hindrance, but then you also have some of the overwhelming pieces when you look at Iraq and the deal of trying to get Kurdistan crude into the CN and into the market through Turkey. So that again is going to keep some of that product a bit held back. So when you look at the U.S., the U.S. is exporting at about 4.2 million barrels a day. That's at the very top end of the infrastructurally possible, and it'll likely stay there because as CN stays low, Europe's going to need product, and we're sending a bit more into Asia because now the U.S. flows are very competitive against the Middle East. And so they're actually helping the U.S. in terms of the exports. So that's going to remain robust, and we're going to stay as close as, if not right at that industrially possible or infrastructurally possible levels because of the demand and the going into both Europe and into Asia. So now when we look at Asian crack spreads, you can see that they've absolutely gotten walloped, and they're down to essentially $14.72. They got as low as $14.22, a slight little tip up. And again, when you go back to 2018 and 2021, they're still at the higher end, but this is the only thing carrying the market right now in these regions, which is why As this weakens, it's going to pull things down. And when you look at all of the ramp up of Chinese product or Chinese refiners, that's why we're seeing a big increase in exports, which is displacing some of this product, putting it back into storage. Then you have Russian product coming in and complicating the situation, which is why storage is building and it's, pushing down those crack spreads. PVM Dubai, when you look at the Dubai versus Brent, you can see that things have gotten, Brent is much cheaper in comparison to historics, just because what's happening in Dubai with the cut in supply, the OSPs, it just makes it easier or more affordable to buy Brent or essentially anything else outside of some of these Middle Eastern flows. Crude oil in the water dipped down slightly, but you can see there's still a significant amount. A lot of that is driven just based on floating storage, but also what's in transit and what is going to continue to be in transit when you look at flows coming from Russia. So crude oil in transit back to a new 2023 high. You can see it's actually pushing towards the 2020 levels. It could actually take out that high as well. It's just there's a lot of product on the market due to these different flows that are being driven by the Russian issues and the Russian shifts in terms of what is coming into the market in general. We don't see that stopping, and that's going to keep a lot of product on the water. Crude oil floating storage, as we were saying, it got a little bit higher than we were expecting. Our expectation was that it was going to average something right around 2022, and you could see it's right back to that 2022 level. And given the amount of product in transit, it makes sense that you're going to have a bit more of that elevated floating storage because of the timing delay. It goes from transit back to floating storage, or it goes from floating storage to transit back to floating storage, and it's just timing delays, and that's where you're going to continue to see an elevated amount of floating storage in the market. Asia came down a bit. When you look at the amount of flows going into China, that's going to stay what we think is going to be right around the 2022 levels, and is going to stay fairly strong. And here's where we're talking about. So the super tankers heading to China are setting a new 2023 record. Seasonally adjusted speaking, it's at a record, and a lot of this is Russian product. There's Russian crude is flowing in because why not? It's priced accordingly, it's priced to move, and they're going to try to take advantage of it. But even at some point, when you look at their flows, some of it was still going into storage, SPR storage, but there's going to be a point in time where even they're capped out. And that's when you could see some of these bigger price adjustments or price corrections lower. Or does Saudi and OPEC try to do something ahead of time? But by doing that, you're creating more pressure on the inflation side. You're creating more pressure on the demand side, which is going to become an underlying issue, which is why we've talked so much about the 70s and the econ show. And even though the economy is slowing, you still have a commodity world that is expensive, which is keeping some of that inflation elevated. When you look at activity, you have a nice little bounce in Chinese activity on the driving side. It's going to stay elevated. You can see it's just moving along seasonal norms. So even the dip was seasonally normal, and now we're going to see some of this remain a bit elevated. Now, when you look at refinery utilization rates, you can see it went from those higher levels in March, and now you're seeing that pretty steady drop in April. This is something that is a bit away from what we were thinking. We thought that we were going to see a bit of a steady increase in utilization rates, not a decline, but it looks like there's some deferred maintenance that's coming through, and that's, again, pulling some of that activity down and going to put a bit more product into floating storage. Floating storage and onshore storage. West African floating storage, it's below 2022 levels, but still elevated. Based on some of the issues with Nigeria, that's going to be a one to watch in general. And you're seeing some of the prices getting cut again to try to clear some of this product, trying to get this into the market in general. Then when you look at the U.S., the gasoline had a nice pop of 158,000 barrels a day of an increase, but we do see a lot of guidance and just based on flows of cargoes that gasoline exports are going to drop, and we expect them to drop fairly hard. Distillate is going to remain under pressure as well. That's going to stay at the lower end. Propane, propylene soaring up 394,000 barrels a day. That's 634,000 above the 5-year. Again, that's going to stay very strong. And then when you look at total crude exports, that's going to stay at that elevated piece as well. Now, when we look at total gasoline, you had that nice little pop, but we see this falling right back to the 5-year average. And depending on really how much product comes into the Atlantic Basin, which seems to be fairly sizable, you could actually see this drop below the 5-year. But right now, just based on what we're seeing on the tanker side, the 5-year average is very likely. Distillate is going to stay very much below the 5-year average. We don't see that bump. And that's just seasonally speaking, as well as competition in the market, which is increasing. Crude oil exports, because of those elevated number OSPs from Asia. From the Middle East into Asia, we're going to see our exports continue to be elevated into Asia, and because of the limitations from Kurdistan through Turkey and the CN pipeline, it's going to stay elevated into Europe. So again, U.S. exports are going to stay strong. And then because of pricing based on the elevated amount of LPG in storage, this is going to stay very elevated as well. Now, when you look at U.S. ethane exports, again, staying strong, remaining at a top clip, and that's something that's going to remain at a positive point as well. Now, when we look at flows into Fujairah, so Fujairah reported 22.87 million barrels in storage, which is a rise of just over 3 million. And this is what we were saying in general, that we expected to see a sizable build. And it was just going to take time because we see these flows, and it's just a matter of when do they get moved into onshore storage, and here we are. So light distillate rose 1.395 million, which is exactly what we were saying is like gasoline or light distillate was going to get a big bump. And here it was with East of Suez gasoline complex softening in early trade. Taiwan exports were expected to increase by the end of the month. And then when you look at just flows in general, there's a lot of flows moving into it. There's some hope that the end of Ramadan with Eid is going to be a benefit. But again, we see this overwhelming amount of product, especially on the light distillate gasoline side, which is going to keep that elevated. Middle distillate had an increase of 945,000 barrels. East of Suez gas oil complex remained under pressure, weighed by supply side fundamentals. Brokers pegged the front month time spread at plus 20 cents. So the spread was less narrower, but Asian demand is stable, but the market is just not good with more gas oil in the region. And the gas oil in the region is from Russia and it's from China. And that's where we see these problems as the East-West arbitrage is very weak, and that's leaving more in that region. Heavy resid rose 668,000 barrels. That's just another big increase. Spot trading activity at the bunker and hubs was above average, but we still see, again, that pressure in terms of just activity and the additional product coming from Russia. Time spreads in Brent are still showing you where we are in terms of just the 32 cents. We don't see that moving too much up or down. It's just because of where we are in the timing of just the amount of product in there. When you look at flows coming from the regions, overall, there's not too much to say up or down. We see things being fairly stable. Vital withdrew an offer for Nigeria's Agbami. And realistically, in the physical market, we're seeing that things are being cut spot-wise between 5 cents and 25 cents. So again, things are still drifting to the downside when you look at the physical market in terms of some of the flows and some of the pricing. European storage is increasing. We see this continuing to increase over the next few weeks. When you look into the refined products, gas oil had a small draw of 26. Gasoline had a build of 5, which is not what they want to see. And now when you look at just where we are for gas oil in Europe, it's actually fairly average. There's not too much up or down, which is going to displace against some of those exports, as we talked about, from the U.S., as well as some of the other products coming into the Atlantic basin. Gasoline, seasonally adjusted record high. We're going to stay here until we get some of these cargoes coming from from Europe back into the U.S. Fuel oil, again, staying at the very high end. And that's, we talked earlier about how there was no east-west arbitrage. There's also no west-east arbitrage, keeping this fuel oil stuck in the market. When we look at total fuel stocks in Singapore, we're moving towards the high end, and we don't see that changing, which again is going to put pressure on crack spreads and activity, refinery activity in the region. Light distillate moving back to the seasonally adjusted highs. Again, we still see this being very elevated, and without a nice bump from the Eid or the end of Ramadan, we see this continuing to remain at the top end of the cycle. Middle distillate kind of bouncing around a bit, but you can see the trend is moving up. We see that trend continuing to shift higher and likely take out that 20 some odd year average. And that's going to be a problem when you look at crack spreads, as we've been talking about with gas oil crack spreads. This is just another example of that. Now, when you look at resid and heavy distillate, you can see that we're moving back to the seasonally adjusted highs. And just given the lack of demand for shipping, the lack of demand in general, and the amount of new supply from both China and Russia, we see that continuing to build. North Sea floating storage went to zero. There was an unplanned downtime, which resulted in some of that. As that comes back, we should see this just normalize a bit, but still stay at the lower end. Europe, on the other hand, had a big spike, and a lot of this was driven based on timing, which is why we do see more builds on the land side, and we just kind of supports that pivot, because as you see, the floating storage came down, land storage went up, and we're going to continue to see that over the next, let's call it 2 to 3 weeks. It's always going to be a matter of timing. So that's what we have for you today. If you have any questions, please feel free to reach out. Hopefully this was helpful, and then tomorrow we'll have our Econ show. So we hope you enjoy the rest of your week. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.